Hi everyone, welcome to another financial analysis video with myself, Moeed, Amin, and my colleague Ted Wayman. We are looking at an interesting company today that's just floated on the UK Stock Exchange. Before we dive into this business, don't forget to like, share, subscribe. If you are interested in the company, whether you're thinking about investing in them or selling to them or doing business with them in some way, shape or form, do leave a note in the comment section giving us your request for that particular company, and we will get round to it. So let's get started with this company. Company today is Podpoint, and continuing the theme of the electronic vehicle connected businesses that we've done in the past, like Tesla and Rivian. This company is a UK-based company, and what they do is they provide electric vehicle charging equipment and points. They've just recently floated on the London Stock Exchange, which we'll come on to. But what's interesting about this company is that they have about 50 to 60%, I think it's more like the 50% market share in the UK for home electronic vehicle charging points. So they command quite a sizable portion of the industry in the UK. And we're going to dive into the finances. You won't see that reflected in the finances, of course, but you will see how to analyze those numbers for any future statements that they publish. The other thing to note about this business, about 50% of this business is owned by a large French energy business called EDF. So they have quite a sizable and well-known and large institutional backing from businesses. And when they floated on stock exchange, they floated at 225 pence per share. Which means they raised about £100 million at the IPO. And at IPO, that meant that they were valued at £352 million. Now it's fluctuated since then. So stick around. We'll come on to that later on. If you'd invested in this company when it actually IPO'd, you'd be sitting on a sizable profit and you'd be pretty happy. But we'll come on to that later on. So Ted, let's take it away. Let's share what we found about this company and its finances, and help our viewers better analyze the financial statements of a company like this or anyone else in the future.
Absolutely. So good to see you, Moeed. Thank you very much. Yeah, so we're going to look at their financial statements now. Trying to find their financial statements is actually quite challenging. There's nothing on their website. And if you go to Companies House, what you've got is kind of holding companies which have kind of all been reversing back and forth into each other. So we're going to use the numbers which are provided in the prospectus, and this is on their website. So if you look on their website, you'll have the prospectus just before they floated. And if you look in the list of contents, you'll notice that it gives you some historical information on page 100. So that's what we're going to use for today's financial analysis. We're going to whiz down to page 100 and see what it is telling us. So here we go to page 100 or there or thereabouts. And what we have is the income statement. Now you'll notice here that they are giving you the 6 months ended June and comparing that to the 6 months ended June for 2020. And then they've also got each of the 3 years. So you can kind of see that the full year ended 20, full year ended 19, and the full year ended 18. And so I'm going to focus on this column here, the kind of the full year. But you might want to kind of keep an eye on this number and think, well, for example, they made 33,000, so 33 million sales in 2020. And if the first 6 months is anything to go by, they're on 26 so far. If they double that, if they do 26 for the first 6 months, they should be able to do 26 for the second 6 months. That puts them on 52 million, which is a pretty substantial increase. So you can start to kind of get a feel for the kind of the growth factor that's going on with this business. It's the gross margin. They are operating at a gross cost of sales is 75%. So the gross margin is about 25%. That's the gross profit expressed as a percentage of sales. Now, I'm not sure exactly what's in that cost of sales. So, I would guess that that's going to be the cost to them of the electricity. So they're going to buy the electricity and then provide the electricity and then sell that electricity. So that's what I'm guessing the cost of sales in. So 25%, a 25% uplift looks pretty damn good to me. You can see the administrative expenses. Now, the administrative expenses, you're starting to see the business. If you halve 20, you get to 10. If you double 13, you only get to 26. So you can start to see as a proportion that the overheads are starting to come down, which means that they are starting to move towards profitability. Now, they're not there yet, but they're starting to kind of, they're starting to move towards some form of break even. That kind of seems to be on the horizon. There's quite a lot going on further down, and quite a little bit of sort of shenanigans going on. Well, not shenanigans, but what I will just identify is this number here. So this is a significant one. It's an exceptional item, and we usually says go and have a look at note number 9. That exceptional item, I'm always a little bit skeptical about exceptional items because they seem to happen on a very regular basis. But this one in particular I have to admit, I haven't quite got my head around exactly what it relates to, but you'll see down at the bottom, it says note number 2. It talks about transaction costs and other exceptional costs. And it says, go and have a look at note 9. And you can also have a look in note B. And if you look in note 9, it's all about an acquisition. So in effect, what happened was that there was a company was set up and then used that to buy the original Podpoint holdings. So Podpoint Group was set up and then bought Podpoint Holdings, and there's costs involved in that. And without getting into kind of too much, we can follow this spaghetti through, but I'm not sure it's really going to give us a much more information about the underlying performance of the business. Suffice to say that the company, that is a one-off, and I think that one-off cost is driving a lot of this loss here. And what we can see is that if we take the 6 months, we notice that it is becoming less loss-making. It's marching towards profitability, and it looks to me like there's a kind of a profitability break-even is on the horizon, not far away, as long as they keep their costs under control. So there's our income statement. If we look at the balance sheet, you'll notice the balance sheet has significantly increased in terms of the size of the balance sheet. So there's the balance sheet at the end of the period, and again, this goodwill here. This is the kind of the goodwill on the acquisition. So this is, we set up a company, we then use that company to buy an existing company, and it buys effectively it's almost like capitalizing its own net assets. So in effect, this is the underlying company that was bought, and what they paid for it, about 85 million. Okay, and the difference is then stuck into goodwill. So that's almost again a little bit of a you can't, it doesn't physically exist. You can't put that on eBay and sell it, for example. So it's kind of reflecting the value of the company just before it went through its IPO. A bit of kind of restructuring going on there. Looking at the current assets are looking, so there's a little bit of window dressing going on in here. You suddenly think, oh wow, look, the non-current assets have increased significantly. Well, they haven't really. You look at the property, plant and equipment. I mean, it has increased, but not dramatically. It's mainly around this goodwill and these intangible assets. That's really where which I think is again a little bit of an accounting window dressing, if that makes sense. Trade and other receivables are up. Current assets have gone up, but nothing really to kind of write home about, I don't think. Current liabilities, so the liquidity ratio is still looking pretty good. So we're comparing the current assets with the current liabilities. You'll notice that there's some debt sitting on the balance sheet. It's come down. The debt has actually come down. There's not a lot in terms of kind of short-term debt, so it is long-term debt, and they are they're paying interest on that debt. And then we come into the equity, and again, it's kind of this. this change here, going from a 25 million loss to a 72 million retained earnings, yet they make a loss in the period, you kind of scratch your head and think, well, what's going on here? And again, this is this account, the way they've accounted for this kind of reverse acquisition. So in effect, what they do is they set up a shell company, they use that shell company to buy the original company, and then they so it's no longer a shell company, and then they float the shell company rather than the original company. And it's just, it's almost like a SPAC, but it isn't. It's like a SPAC, but not in the order that you would expect. So it just looks to me like there's kind of window dressing going on here, and effectively what they've done is that they've realized the value of the company in its own balance sheet, if that makes sense. So it's quite hard to get your head around. We need to be careful that we don't suddenly look at these two numbers and say, oh wow, it's really improved. It's still the same business. It hasn't really changed. And I think that's an important thing to drill home, that this 72 million, this is not retained earnings. This is not, the company's been making profits and hasn't paid it out as a dividend. And I think it's window dressing. Anyway, we need to be very careful when we read these numbers. So that's the balance sheet. If we look at the cash flow, so again, you can look at this retained, the accumulated retained earnings. So this is kind of where we see it. So here's the loss at the beginning of the year. That's the total loss they've made ever since they started trading. And then suddenly you notice that the loss on the 28th of January just goes to zero. Okay. And it's kind of like, it gets wiped out and then replaced with what they call this capital contribution, which is part of this kind of this reverse takeover, so to speak. And suddenly they end up with retained earnings of 72 million. And you just kind of go, well, that just, it isn't retained earnings. I don't know quite how or why they've managed to kind of put that in. In effect, what they've got is they got a formally waived loan. So they had a loan which was 85 million. The people said, oh, you don't have to pay it back. So they said, great, we can recognize that as a profit because, effectively I've borrowed the money, but I don't have to pay it back. So it's a bit like you borrowing £1 million, buying £1 million house, and then the bank phone you up and say, you know what, don't you worry about it. You're suddenly like, wow, I've just made £1 million. That's kind of what's going on here. But you know as well as I do that is not earnings in the sense that, it's not like a salary where I've had to work for it. So again, there's an accounting anomaly going on here, which is just a little bit strange. So, perfectly legal, I'm sure, because the auditors have signed it off, but it's not really, these numbers are not really reflecting the underlying reality. Here we have the cash flows for the business. So they are making a loss. And they are actually generating, they're making a cash loss as well. So there's a cash burn going on. Here's the cash burn. Sort of 6 million, 7.6 million for the 6 months last year, 5 million for the 6 months of this year, for example. So, cash burn, profitability, or rather the loss making is coming down. They are starting to, reduce their cash burn, but they are still burning cash. You'll notice that they've got, cash in the bank at the end of the year, 1.6 million. So, they're still burning cash, and they need to make sure that, they're not going to effectively run out of cash. So don't forget, this is all pre-IPO. So, as a result of the IPO, they would have raised a whole lot more money. They'll have a lot of money sitting in the bank. I don't know exactly how much they've actually got, but it'd be interesting to see the next set of results, which shows the effect of that IPO. And that will then we'll be able to determine the cushion as to how long they can continue to burn cash for before they have to go back and tap the shareholders, or whether they are actually going to get to a positive break even on their cash. So again, we've got this kind of, these anomalies. So if we look at, there's our kind of the acquisition of subsidiaries. you know, which is again that kind of that takeover, and then the borrowings forgiven. So again, you've got some big numbers coming in here, which I think, you know, again, are just, you know, somewhat distorted. We kind of need to, you know, really kind of read it, just strike these numbers through and look at the underlying numbers, and we can kind of see that, you know, these guys, you know, there's a little bit of investing going on. You'll notice that they've taken out some loans, they've got some additional debt on the balance sheet, and that's been, you know, that's what they were doing at the end of last year as well. So sum total for their cash flow is that, you know, they generated cash mainly by taking on loans. They've raised more cash through their IPO. They'll probably be sitting on quite a lot of cash, but they basically just boosted up their balance sheet to make it look a lot nicer than maybe it is. So they took a balance sheet which was, you know, fairly weak looking. They've reversed it into a shell to kind of, you know, effectively recognize the goodwill inherent in the business, and then taken that subsequent company and floated it and said, look at our company, it's got a bigger balance sheet. So, you know, we just need to be careful about the difference in the sizes of those balance sheets. You know, I'd almost be tempted to say, look at the year ended December the 31st, 2020, because that's really the company you're buying. But let's go back to that balance sheet and just re-emphasize that point. So in effect, what this company have done is they have taken effectively nothing up here. They've created a lot up here, and the other side of that is the other side of that asset is to effectively show it in the equity down the bottom. So they've taken an equity balance sheet which was about 7 million and turned it into a kind of a 92 million. Even so, they're floating, you know, 300 and I think I looked today, the share price, you know, has been, you know, has been increasing. As you said, you would have made some money on the if you'd invested at their flotation. There it is. It's pretty old, so there's not a huge amount of trading history. Interesting enough, I couldn't quite work out why it's not given me a market cap on this a particular website, but you know, it didn't. But you know, looking it up, it was about 375 million, something like that. So 375 million on a balance sheet of, let's just remind ourselves, on a balance sheet of 92 million is, you know, you're paying, you know, over the odds for it. You know, well, I say over the odds, you're paying above book value. But if you were to pay 375 million on a £7 million balance sheet, then you'd be thinking, oh, wow, hold on a sec. You know, really, that is all goodwill. So in effect, what you're doing is you're paying for goodwill on top of goodwill. There's already goodwill in there because of the way they structure this flotation. So, you know, I kind of, you know, I look at, you know, to me, that's kind of, you know, that's an alarm bell that, you know, there's a lot of window dressing going on. It looks very nice. But underlying, I'm not convinced by the way that they put those numbers together. It's you know, they're trying to paint too rosy a picture, and therefore I think that, you know, certainly, you know, and I may be wrong, maybe they're going to dominate the whole of the UK and then go into Europe and the world and you know, and do charging points everywhere. But you know, it's an expensive company today. So because A, it's expensive, and B, because of the way they presented those figures, it's not something that really, you know, appeals to me. I'd rather have a company that produces honest figures, let's say.
Okay, I just want to share with you what I think is going on with this company. So what we're showing on the screen right now is the balance sheets, and I want you just to have a look at the three balance sheets. So this is end of 2017, beginning of 2018, end of 2018, and end of 2019. And this is a fairly consistent view of the organization. So if we look at, I've put those into a spreadsheet. Here they are. You see the net assets are about £1 million pounds. They're £1 million again. they're £1 million again. So we're seeing a fairly consistent view of this company. Net assets were actually negative £1 million. There we go. In 2017, we've gone positive. And then you suddenly notice here that from 2019 to 2020, there's a big jump. There's a really, really big jump. And I've been trying to work out what's going on here. And I think I have managed to work it out. And I thought I would share that with you. So 2017, 2018, 2019, everything is going fine. Now, what happens at this point is the company appears to set up a shell company to buy it. So they set up a new co. Now, I've slightly had to kind of make up the numbers here. But in effect, they've set up a new company with investment of 26 million pounds, 26.4 million pounds. And that is this number down here. So this is where I'm picking up the number from, the 26,400. Okay, so this is effectively, all of that is just gone to zero. And there is our new share capital, for want of a better word. And they also borrow about 85 million pounds. So they've got about 85 million pounds of borrowings, an investment of 26,000. So they raise about 111 million pounds. Okay. Now, I think the owners have lent this money. So this money is from the owners. They've actually, the owners, they've invested 26 million and they've lent 85 million into this business. Okay. Now, what they then do is this new co then buys the old co. So let me just stretch this out a little bit. Here we go. So we can see, so the old co is this kind of 2019. They set up this new co and they buy the old co. Now, if you buy a company, if you pay, and I think they're paying about, it says in the accounts here that they pay, and I've got the numbers in the cash flow. They talk about this this acquisition of subsidiaries, 85 million. So I'm going to assume that they've bought this old co for 85 million. So this is the 85 million. So they pay 85 million, but they're buying a company with a net asset value of about 7 million, which means that they're paying about 78 million too much. Okay, and that is what's known as goodwill. And goodwill we can capitalize on the balance sheet. And it seems to me that that is what's going on here when we see in the balance sheet. Let's go back to our balance sheet again, and when we see this 77 million of goodwill. So that goodwill is effectively just creating this shell company called Newco, using the Newco to buy the old co. Okay, so the owners, they've invested 26 million of their own money. They've borrowed 85 million. They created this Newco. They've now bought the old co, and they have this company. Here it is with 26 million. What they then do is they've effectively then said, we're going to write off the debt. So there's a debt write-off, and we see that in the cash flow here. The debt write-off, there we go, borrowings forgiven, 84,566. So I've put that into the spreadsheet, and so the borrowings have reduced by 84,566. You can see that in my kind of in the calculation up at the top here. So the borrowings have come down, and they've booked that as a profit. So the retained profits have now increased as a result of that. And again, we can see that in the movement in equity. So the movement in equity, here's the share capital. Let me get my annotation out. So the share capital, at one point, it was kind of these two numbers. Then it just went to zero, and then they started it with this kind of this new co. And then what you'll notice here is this kind of this capital contribution, which is effectively this kind of this write-off of debt, which means that the accumulated earnings, they have effectively managed to kind of show a profit on the write-off of debt. They book it through as earnings in the company. So this results in a balance sheet that's looking pretty strong now. So 2020, they're looking at a company which has got, you know, net assets of 100 million. It's got a little bit of debt, but not too much debt, and it's stuffed full of goodwill. So there's a kind of, you know, there's a kind of manufacturing going on here to make the company look, I think, better than it actually is. And of course, you know, if you are the owner, if you've managed to stuff that 110, 111 million pounds, sorry, into the company, and then you can realize, you can sell your stake, make the company look much more valuable than it is, and then can sell out for more than that. Obviously, then there is a little bit of financial engineering going on there. The only other thing I would also like to point out, let me just clear these annotations. So the only other thing I'd like to point out is I'm looking at this balance sheet here, and I have to admit I really am struggling on some of the calculations. So maybe I'm missing something and somebody can help me out here. But when I add up these four numbers, which I've done for you here, there are the four numbers there. I get 1468. I certainly don't get 1443. And again, when I add up these numbers here, and again, I've done that for you here, I get 17325. I don't get 18045. So there's a little bit of a difference going on here in terms of the calculation. I'm not sure, if a company's prospectus, if the numbers don't add up, then that makes me a little bit nervous as well.
Yeah. No doubt, whatever anyone's point of view is, that was certainly an interesting find about this company. And definitely we've helped our viewers become smarter in reading financial statements from just that one point. But don't forget, we are looking at backwards producing numbers. There's obviously looks like a credible and potential growth from this business, particularly if they command such a large market share. And if you think about electronic vehicle manufacturing and the growth of that and the growth of use of that, there's certainly a story there to actually keep a close eye on. So great analysis of this company. Love to hear everyone else's thoughts on this. If you're in the industry, if you know something very, very deeply about this business, do leave a note in the comment section. This is a community at the end of the day. And of course, like, share, subscribe. A lot of people ask us, how can they help us? How can they help us get the word out a lot more so that people are more educated financially? Well, you can do so by sharing and by leaving a note in the comment section, and certainly liking our video. So until the next video, thank you from myself and Ted Wayman. We'll see you on the next show.
See you later, Moeed. Good to catch up with you.